The Australian Financial Review.
Well, very good morning, ladies and gentlemen, and welcome to today's auction. My name is Ben Mitchell, representing, of course, the team at Adrian William Real Estate, and it certainly is my privilege and pleasure to be your auctioneer here today.
Last Saturday, producer Lapfan and I went to an auction in Sydney. At a time when prices are falling, competition for this particular house in Marrickville was surprisingly steep. A few years ago, the suburb was voted by Time Out magazine as the 10th coolest neighbourhood in the world.
1655 on the left to go. And over to 16 and 55. 65.
There were 9 registered bidders, but the early contest was between a man in his 50s buying an investment property and a young couple looking for a home.
1670, 75. 1675. 80. 85, 1685, and a bit 16 and 85, 17.
The investor won that battle. But then there was a last-minute entry from a young woman in the corner.
1720 for bidder number 5, 17 and 20. New competition, so you beat everyone else. It doesn't seem fair, does it? 17 and 20, so call 5 or better.
And that bid pushed the purchase price above the expectations of the sellers, Rachel and Nathan, who'd moved back from Shanghai and decided to swap cool Marrickville for a place closer to the city.
We are going! We are going! We are going. Congratulations and well done.
For Rachel and Nathan, this was the end of a roller coaster ride in the Australian housing market. They first started looking for a house while they were still living overseas at the beginning of last year.
21, when prices started to go really crazy, and it was when we actually returned to Australia again, we kept looking, and it was a little soul sort of crushing, I think, because the prices were just sort of so out there.
But then, as interest rates started rising this year, prices began to fall. In the end, the couple paid less than they thought for their new place, but also accepted a lower price for their Marrickville home.
I think sort of 6 months ago, if we tried to sell our house here, we would have got probably another 200,000 to 300,000.
Welcome to The Fin. I'm Lisa Murray. Today, on the last episode for the year, we talk with the Australian Financial Review's Deputy Property Editor, Michael Bleby, about the housing market's wild ride, why prices are currently falling, and what might happen next year. It's Thursday, December 22. Michael, it's been an unpredictable few years in the housing market, to say the least. So let's start with the pandemic surge in house prices, because that's a big part of the story. Explain to us what happened.
Well, Lisa, when the pandemic hit, nobody knew what was going to happen, least of all policymakers. So the people at the Reserve Bank went for the safest option, which was to cut lending rates on money to encourage the economy to tick over as smoothly as possible. But by cutting interest rates to record lows, all of a sudden it gave people more money than they had ever had to put into assets like residential property, particularly at a time when other potential investments looked shaky or no one knew what was going to happen. Residential property seemed like a much better bet.
Melbourne property prices are on a post-lockdown roller coaster, with 5 suburbs on the Mornington Peninsula booming. Units and apartments are also in demand as first-time buyers cash in on record low interest rates.
Despite predictions of a pandemic crash, Sydney house prices have soared to a record high, and experts claim prices are about to go through another surge.
Demand for regional housing across the country is already outstripping supply. That means that prices are likely to continue to go up, which won't please everyone.
So we had extreme examples, like a house in Sydney's Bellevue Hill that in 2021 in October sold at auction for $12.2 million. Now, this was an untouched 1960s home that had been sold just 2 years earlier in exactly the same condition for $6.1 million.
Wow, it doubled.
It doubled. And nothing had been done to the house. It's just that 2 years later, in October 2021, all the people who were chasing it could borrow for next to nothing. And so you just had huge volumes of money going into residential real estate. Overall in 2020, dwelling prices went up about 30%. Now, that's across the board. It was more extreme in regional areas and rural Australia, where we had this phenomenon of the rush to regions, where people who were either wanting to escape lockdown in the large cities, or people who realised that they didn't have to work in the office anymore but could work from home, were all of a sudden able, in a way that they'd never been able to before, to leave their suburban house or to leave their inner city apartment and go somewhere that gave them more space and for less money. So we had large numbers of people getting out of the cities and buying up in regional towns in a way that we'd never seen before. That meant prices in the regions rose by up to 40%, while we saw an average across the capital cities of price rises of about 25%.
But then inflation became a real problem in the economy, and the Reserve Bank responded by lifting interest rates. So, Michael, isn't it the case that while noting we're coming from a very high base, Australia is actually in the middle of one of its worst housing market downturns on record?
You're right, Lisa, that interest rates have risen. And for many people, this is the first time this has happened. The current cash rate now of 3.1% is the highest it's been in a decade. So there's a generation of home buyers who've never seen rising rates before. It's not the worst fall that we've seen in prices to date. The longest and the most prolonged one would have been over the near 2-year period leading up to mid-2019, when you had a combination of banks cutting back on loans to investors, concerns about the possible loss of tax breaks like negative gearing and the capital gains tax deduction ahead of the 2019 federal election, and that triggered an overall decline of about 10.2% in dwelling prices. So far, we're down about 7.5%. Now, economists do expect prices to keep falling into the new year as the effect of further rate rises takes hold. And most are predicting a decline of about 15%, which would make this the largest single decline that we've seen in dwelling prices, but we're not there yet.
So we've been talking about the housing affordability problem in Australia for years now. Is there a silver lining with this downturn? Is it making it a little bit easier for people to afford a house?
Lisa, that depends on your definition of little. And probably, yes, it does make things a little bit easier. But a problem we seem to have with the Australian housing market is, yes, we cycle through these upturns and then downturns, but the downturns are never quite enough to fully offset the previous gain. So it's not linear, but in an affordability sense, prices do keep going up. So we've seen over several decades that this problem of affordability is just getting worse. We often hear examples of the late 1980s when mortgages were being charged at 18%, and people say, quite rightly, those costs were much greater then than they are now. Well, yes and no. If we were to jump back to 1984, the average home cost about $64,000, and the average income at that stage was about $20,000. So, the house price to income ratio, very crudely, was about 3.3 times. If we jump forward to 2022, the average home costs about $920,000, while the average income is just $91,000. So that makes the house price to income ratio 10 times. So yes, the interest rate that we're paying on our home loans might be lower than it was back then, but the amount of money we're paying out for them is a whole lot more.
So, Michael, it's fair to say that the biggest impact on house prices is rates. When they're low, house prices tend to rise because more people are willing to take out loans to make purchases. And when they're high, it has the opposite effect, as you talked about. But as late as November last year, Reserve Bank Governor Phil Lowe said rates were likely to remain at record low levels until 2024. Explain to us why that was so contentious, but also why the central bank believes Australians are well positioned to handle the latest round of interest rate increases.
Well, Lisa, I think when the Reserve Bank Governor talked about rates being on hold until 2024, perhaps we should have the caveat he wasn't giving financial advice. He was talking about, I suppose, the bigger picture of the economy.
We thought the pandemic was going to have long-lasting disruptive effects on the economy, that would keep inflation low, would keep unemployment high for years.
But, quite reasonably, a lot of people took Phil Lowe at his word and thought, well, I can afford to extend myself because I'm going to be able to enjoy this ultra-cheap money for a couple of years longer at least.
So it was highly conditional. It was not. We did not make a promise. I know it was interpreted that way.
And with that idea in mind, lots of people went out and bought themselves a property. Now, this is where the biggest problems arise, because these are the people who perhaps bought because they could borrow large sums cheaply. But also these are the people who now, having bought most recently, have the least equity in their homes, so that as rates and borrowing costs start rising now, they've got the least resources to fall back on to tide them over as they need to fork out more.
The health situation improved much faster than the advice that we and others had, and we've had to rewind those decreases in interest rates. And
to be fair to the RBA, it was reasonable to think on their part that people would be able to withstand higher rates when they started going up. After all, Australians have built up a lot of equity in dwelling values that have been surging. But also, Australians are actually quite good at paying back their mortgages. In fact, in recent years, with rates being low, a lot of people have actually paid off more than they needed to by putting buffers for themselves in offset accounts and the like. So it's fair to expect, if you're looking from the position of someone like Phil Lowe, that Australians should be comfortable even when rates start rising, because we've got these buffers in place.
But I also ask you to reflect on the fact that the economy is so much better than what people thought was going to be the case. Interest rates are higher. I know people don't like that, but you should be welcoming the stronger economy. And again, that's what I'd say to people who kind of unhappy with the promise, which wasn't a promise, but that's what I'd say. You've got to remember that. The economy is so much better.
But Lisa, while the RBA isn't concerned about the prospect of a housing market crash, there will be a big test coming next year. Mid-year, going by the estimate of investment bank Barrenjoey, a third of all mortgages are due to come up for refinancing. These will come about because people who locked in their mortgage at fixed rates when they were low are going to get a rude shock when they go to refinance. Not only will rates be higher, but they'll be taking out loans at a higher rate at a time when, for many people, their home has gone down in value. By some, it's being called the fixed rate mortgage cliff, and a huge number of Australians are heading straight towards it.
Michael, we've been talking about the prospect of the fixed-rate mortgage cliff, which is expected to hit the market sometime next year. Can you tell us a bit more about the scale and scope of the fixed-rate mortgages that will need to be refinanced and what impact that might have on the market?
Well, Lisa, if you think about what fixed rates have done, many people were able to take out a loan at a rate below 2%. Now, next year, when the time comes to refinance, they're going to be looking at rates of 6% or more as lenders pass on the rising costs of cash. That's a huge increase. So, Lisa, for someone with a $1 million mortgage that they're converting from a fixed rate into a variable mortgage, that could mean their mortgage repayments rise by more than 50% to about $2,300, taking their monthly repayments to $6,500. Indications are that nearly 2 million fixed-rate loans, including loans split between fixed and variable rates, worth more than $450 billion, are due for renewal in the next 16 months. I spoke to ANZ senior economist Felicity Emmett about this.
Michael, hello.
I'm just, thank you for doing this. I've just asked you to give us a couple of basic lines just to set the sound levels and checks that
She made the point that before the pandemic, about 15% of borrowers took out fixed-rate mortgages. But as people rushed to lock in ultra-low borrowing costs, that number jumped up to about 35% of people. And these are the people who are now going to be in for a shock.
It will be quite disruptive, particularly for those people. It will be quite a significant adjustment in terms of their repayment and what proportion of income they need to then put aside for those repayments. But the main impact from the rollover is on consumer spending. Now, where it could flow through to the housing market is if those rollovers cause so much stress for a significant proportion of borrowers that then we see a rise in forced sales. Now, I think that is unlikely that we're going to see a material rise there. We can't deny that there will be people that do struggle with these higher rates, and we will see over the next couple of years mortgage arrears start to rise. But I don't think they are going to rise to a level that is going to be problematic for the broader economy and certainly not problematic for financial stability.
Michael, it's interesting that Felicity is saying the main impact of the fixed rate mortgage cliff will be on spending rather than specifically on the housing market.
Mm-hmm.
At the auction on Saturday, I spoke to real estate agent Jason Ballo, and he had a slightly different view. Let me play you some tape.
People won't want to reduce their lifestyle means, it's all going to come down to that. And at the end of the day, if people can't afford to go out and all of that, then they'll reevaluate where they're living and probably look to downgrade at some point, because that would make sense, because it's going to be a long-term thing. It's not.
And Lisa, I suspect there will be people who do that. After all, their mortgage costs are just one of a number of expenses that people are going to have to deal with in the coming year, along with inflation and higher costs of living across the board. So I asked Felicity about the outlook for the housing market, and she said it's important to note that the current downturn comes after that big jump in prices that we all saw during the pandemic.
What are you predicting for calendar year 2023?
Look, we're thinking, when you look at what prices have done so far, in terms of capital cities, they're down about 7% so far in 2022. Next year, we're expecting further significant declines. Together, we're looking at peak to trough declines of between 15 and 20%. Now, I think, though, what's important when we look at this is to give it some context in terms of the run-up in prices. So prices were up around 25% in terms of capital cities through that pandemic boom. And so with that, on our forecast, capital city prices on average will be about 3% higher at the end of 2023. Now, when you look at some capital cities like Brisbane, for example, those prices were up more than 40% through the pandemic. And so an 18% or so unwind would still leave them 18% higher. So I think it's really important that when we're talking about these, what are very large falls in house prices, that we think about, put it into context of the very, very quick acceleration in house prices that we had through 2020 and 2021.
All right. Fabulous. Thanks so much. Really appreciate your help with this.
Michael, I'd like to play you another piece of tape from last weekend's auction. We spoke to Ben. He was one of the bidders who missed out on the property. And I asked him about the downturn and whether that was making it easier for him to get back into the market. But he said that the headline falls that are talked about of around 7 to 8% this year, they don't reflect his experience. Let me play you this. Do you think, obviously in the last 6 months, the consensus is that it's come off? Is that your experience?
No, they say that, right? The headlines are saying that the market's coming off. And, there's an 8% drop in Sydney this year or whatever it is. But the reality is that in the suburbs that I'm looking in the inner west, that's not the case at all, not for good properties. Some properties that are perhaps need a bit of work and stuff, I think there are bargains to be had if you're willing to do that. But with the the cost of building and the difficulty getting, materials and actual tradies to turn up, that's not really an option that we want to pursue. So it's, those properties that are ready to move in and, are nice are still getting, premium prices, I think, or getting good prices anyway.
I think Ben makes a really good point. There isn't one property market in Australia. There are lots of them. And, if Ben's competing for a home in Marrickville in a Western Sydney, that's a different market from Campbelltown in southwestern Sydney, or Perth, or Adelaide. So while journalists and economists can talk about the market as a whole, there are a whole lot of very different lived experiences by people in each of Australia's many individual markets.
So, Michael, let's look beyond next year. What are the fundamental factors affecting supply and demand of housing over the long term?
Demand's going to pick up, particularly as inbound foreign migration resumes. Australia's always been a net importer of people, and after a few years of disruption due to the pandemic, that's going to resume. Everybody now seems to be agreed with the idea that we need to increase housing supply. We need to build more homes. That's homes for people to buy and housing for people to rent, be it long-term affordable rental housing or social housing for people on lower incomes dependent on social welfare. We just need more homes. But even though we all agree that's what needs to happen, it's not going to happen fast enough to offset this much shorter-term growth in demand. Anyone who's trying to rent a property at the moment, be it for work or for the coming academic year, would be able to tell you that. Rental vacancy rates are at record lows and rents are soaring.
And let's talk about what else might affect the housing market. The tax treatment of property has always been a hot political issue in this country. What about the outlook for government policy settings and their potential to affect the housing market? What's going to happen over the next few years, do you think?
Lisa, when you think about taxation and property, I think negative gearing is really like the Voldemort of the housing market, the he who must not be named. After Labor took policies to the 2016 and 2019 federal elections promising to get rid of negative gearing and its stablemate of the capital gains tax deduction and lost both elections, it jettisoned both of those policies. By way of background, Lisa, negative gearing allows you to claim tax deductions from the costs of owning an investment property against all other income, while the capital gains tax deduction cuts in half the capital gain that you make when you sell an investment property. And arguably, they play more of a role in stoking demand and pushing up prices than negative gearing itself does. But with the government's energy legislation now out of the way, it may come under more pressure to do something about housing affordability. Negative gearing seems off the table for the foreseeable future, but there could be room for the government to move by revisiting the capital gains tax deduction.
So what does all this mean if you are sitting there wanting to buy or sell a property? Is this latest downturn just a dip in what is the long-term relentless rise of house prices? And does history give us clues about how markets recover and where the first signs are?
I think the biggest influence on the housing market is going to be what happens with interest rates. Most economists say that they're still rising and they're not going to reach their peak until mid-year. After that, they're likely to hold for a bit and we could see rates start to come down as we go into 2024. But I suppose it gives us a chance to think about a couple of things. As we've discussed already, the current fall in housing prices isn't really going to affect the trajectory of housing affordability, which has long been a problem in Australia and is going to continue to be a problem. Nor will it affect those fortunate people who bought property in the 80s and have managed to stay in home ownership all that time. Nor do I think it's going to do anything to shift the dial on something we've seen over the last several decades, which is falling home ownership rates, particularly among younger people. So perhaps the next year is going to give us an opportunity to think about something quite big for our economy. And that's the question of what role should housing play? Is housing a basic service? Something that everybody needs to be able to access easily and cheaply and securely? Or is housing in this country a wealth creation instrument? And whichever way we go, the outlook for the housing market is going to be very different because we will shape policy to fit whichever of those two visions win out. But I suppose in the shorter term, as we look into 2023, it's going to be a white-knuckle ride. If you are somebody who's taken out a mortgage, it's going to be a difficult year. It's going to be expensive, and it's going to be a great time of uncertainty. But for the homeowner and mortgage holder, if you can hold on through to the end of the year, it should get easier in 2024.
Thanks, Michael, for joining us on the last episode of the year.
Thanks very much, Lisa.
Here's the other big stories we're covering this week. Optus Chief Executive Kelly Bayer-Rosmarin has revealed that before going public about the cyber attack that affected almost 10 million of its customers, she alerted security and government agencies and ranked the chief executives of major companies to warn them to be on their toes. In her first interview about the incident, she said the company decided very quickly the best defence against a hacker was to create a climate where they couldn't profit from data. And Japan's central bank stunned financial markets by loosening its grip on the benchmark government bond rate, paving the way for a possible departure from decades of easy money policy. The Bank of Japan will widen the band within which it allows the 10-year government bond yield to trade. The surprise decision triggered a surge in the Japanese yen. Thank you for listening to The Fin. I'm Lisa Murray with Michael Bleby reporting today. The Fin is produced by Alex Gow and Lap Fan. Fiona Buffini is the executive producer. Our theme is by Alex Gow. If you like the show and want to hear more, follow us wherever you get your podcasts and consider rating and reviewing us as it helps others find us. For more stories about markets, business and power, subscribe to The Financial Review at afr.com/subscribe. The Fin will be back on January 26. See you next year.
The Australian Financial Review.